The year is 2024. Coming down from a high of almost $300, Tesla stock is now trading at around 175. My allocation is probably higher than it should be. I'm looking for a way to protect this position. I decide to write a covered call. This is the landscape when the story begins. Welcome to this video on when a trade goes wrong. The first decision. With the share price at $175, I chose the $185 strike and a 3-month expiration, being July, to get a good premium. I sold one contract at $12.10 for an income of $1,209.33 after fees. This gave an upper break-even price of $197.09, which is the 185 strike plus the $12.09 premium received, and compensated for a decrease down to $162.91, the strike price minus the premium received. The second decision. All went well until the share price took off in July 2024. The price broke through 197 all the way to 246. In one way, the strategy worked perfectly, as it was worth max profit. But what were my options at that point? Do nothing and let the shares be assigned? This would be in line with the initial thought of being too heavy on Tesla stock, but could I do better? I didn't really want to miss out the difference between 246 and 185. $61 per share is a lot. The solution: roll the position. The roll. A roll is a two-legged transaction that closes out one position and opens a similar one of the same type. It will be the same type of option, a call in this case, and on the same underlying stock. What changes is the expiration date and/or the strike price. It would cost me more than $64 per share to close the position. I looked for a new call to sell that would make more than that. It turned out I could both roll out in time and up in strike. I sold the October 2024 $190 call for $67.95. First step, buy to close the July 2024 $185 call for $64.70. This generated a big realized loss for the 185 call. $1,209 received when opening the position and $64.70 paid to close it. Next step of the roll, sell to open the October 190 call for $67.95. This gave a net roll of $325, bringing in $324.49 after fees. It also made the position worth $500 more if assigned. This gave an upper break-even price of $205.33, 190 plus $15.33 combined premium received. The third decision. The price came back down, even going below 190, but ultimately stayed high above the break-even price. As trades go wrong, this is probably the best kind. I'm only losing out on potential gains, not losing money. If I had done nothing, I would be ahead of where I am now, though. I was again faced with the same decision. Do nothing and let shares be assigned, or roll the position. The roll. It would cost me more than $55 per share to close the position this time. Again, I looked for a new call to sell that would make more than that. Turned out that I could both roll out in time and up in strike. I sold the January 2025 $200 call for $56.91. Buy to close, October 2024 190 for $55.46. The 190 call actually showed a realized profit on its own due to the share price being lower when it was closed than when it was opened. The profit was $12.47. Sell to open the January 2025 200 call for $56.91. This gave a net roll for $145, bringing in $143.52 after fees. Again, it made the position worth $500 more if assigned, and gave an upper break-even price this time of $216.76, the 200 plus the combined total premium received of $16.76. So where am I now? The price initially came back down below the break-even price, but then several bursts and the price really took off. There's still a lot of time value left in the short call, so no action to take right now. In general, so far I've been able to roll for a profit each time. This may not be the case every time. When the share price is so much higher than the strike price, I'm okay with rolling at a cost as long as the strike price increases by more than the amount I'm paying. The reasoning is that if I'm assigned, I'll make that money back and more. I feel that I'm still generating a return when paying to roll to a higher strike price that is also far below the market price. And the assumption being that the market price will not fall that low, and I'm essentially getting the difference between the strike increase and the premium paid with little risk. Thanks for listening. If this was of interest to you, please comment or like to let me know if I should let you know what happens.